All right, let's do the other half of the video. So we're going to keep going. And what we have here is an example that goes on to 2 pages, maybe even 3. Yeah, practicing doing cash flow. So this is a fun example because it's a good review from everything that we've done. So look, we haven't done T accounts in a while. Oh, am I not sharing my screen? Great. Let's go back here. All right, share my screen. Glad I noticed before I got too far in the video. I would have just done the whole video and not been sharing my screen, and then I have to redo it. That would suck. Okay, so back over here. Okay, so the next 3 pages are all connected because we're going to do some T accounts and we're going to do the financial statements. And we're going to review all 4 financial statements. We haven't done all 4 in a while, so this is good. We haven't done income statements since chapter 7. I don't think we've done balance sheets since chapter 4. And so this is great review. For you guys in an 8-week class, it wasn't very long ago, but if you're in the 16-week class, it was quite a while. So Christie's Cleaning example was formed on January 1 by issuing owners common stock in exchange for cash. So we'll do cash and common stock. And so what we're going to do is we're not doing the journal entries. We're just putting them directly into T accounts. So we haven't done that in a while, and I could write out the journal entries, but I was trying to save time. So if I were to write out the first journal entry, it's money from owners. So it would be a debit to cash. And then on the second row, you would go and you would do common stock. And you don't have to do this, but I'm just saying, like, if you were to do it as a journal entry, that's what it would look like. And we would do 2,000, 2,000, and then we would do the next one. And we could do like all of the journal entries like that, but I'm just going to put them directly into T's instead. So every journal entry has to have a debit and a credit. And so if we get money from the owners, we are going to put that in cash. Cash is an asset, so it has a debit balance, ADE or debits, and we are going to credit common stock. The next thing we're going to do is we're going to provide services to customers for 500 cash. So we're going to receive cash, and that is revenue. So I debited cash and I credited revenue. We also incurred expenses and we paid cash. Paid cash, credited cash, debit expenses. Letter D, we're going to buy land, pay cash. So when I buy land, I debit land because land is an asset and it has a debit balance, and I paid cash. So cash is a credit. We're going to borrow $1,000 in cash. So cash is going to go up and it's through the bank. So I'm going to credit notes payable because I'm going to have to pay it back. Now it says the company borrowed $1,000 on December 31. So we're not going to have to worry about any interest or anything until later because we're not going to pay any interest right now. So we're just borrowing the money. And then it says we paid a dividend. So when you pay $50 as a credit there, ADE are debits, and so dividends is a debit. So all of our accounts only have one number in them except cash. So I need to find my cash balance. So cash is an asset. So I'll do the 2,000 and the 500 and the 1,000, and then I'll subtract 300, subtract 1,500, subtract 50. And I have cash of 1,650. And then my other ones, I only have one number, so I'm not going to rewrite the balances, but I see land. Oh, I guess I might as well. 1,500, notes payables 1,000, dividends is 50. Why did that one not automatically double underline? The rest of them did. And then revenues sitting there at 500 and expenses are sitting there at 300. And you did not have to rewrite those. We all saw what the balances were. So to find the balance in a T account, the bigger side is the balance. ADE should have balances on the debit side. We could do a trial balance and see if our debits and credits equal. If we did that, we would take the 1,650 and the 1,500 and the 50 and the 300. Those are all the debits. Oh, goodness. And so if we add those together, and again, we didn't have to, I'm just kind of reviewing with you guys a little bit. 1,650, 1,500, 50, and 300 are my 4 debits, and I have 3,500. My credit balances are notes payable, common stock, and revenue, 3,500. So I'm in balance. But what I want to do now is I want to go on to the income statement. I'm going to do revenues minus expenses is net income. So revenues were 500 and expenses were 300. So my net income is 200. This was a brand new business this year. So the beginning retained earnings starts at 0. The net income, I just found it. the dividend was $50. So I'll do minus 50 to get $150 for ending retained earnings. For my assets, I only have two. I have cash and land, $1,650 and $1,500. For a total of $3,150. Then notes payable. My notes payable was 1,000 and my common stock was 2. And then my retained earnings comes from here. I don't want to use the fact that I had retained earnings. I had no retained earnings on the previous page. I use ending. So that's 150. So total owner's equity is 2,150 and total liabilities and owner's equity is 3,150 and I am in balance. So the last thing, so usually we just do those 3 financial statements is what we did in chapters 2 and 3 and 4, but I'm bringing back cash flow. So that's why we went through this problem. So for cash flow purposes, I would need to go through these transactions and identify which ones are operating, which ones are investing, and which ones are financing. So this money from owners, this 2,000 goes in the financing section. So one way to do it is to take the T account and just label them. The 2,000 goes in financing. The 500 is from customers. Customers are operating. The 1,000 is a loan, so that's financing. The 300 just says expenses. And so that's going to go in operating because it didn't tell us that we were investing in ourselves or financing. So the 1,500 is land, so that's investing in ourselves. And the 50 is a dividend. Paying a dividend is financing. So that tells us what sections things go in. So it looks like I'm going to have 2 items in the operating section. I'm going to have 1 item in the investing section and 1, 2, 3 in financing. Because this was a brand new business, we had to do some financing transactions up front. So you didn't have to do that because you could have just jumped to the income statement and plopped the numbers in. Because I see my 2 numbers from operating. So cash received from revenues was 500 and cash payments for expenses were 300 for a total of 200. I paid money for land. I paid 1,500 for land. I also got money from owners. I got a loan and I paid a dividend. And so those are the 1, 2, 3, 4, 5, 6 transactions sitting in my cash account. 1, 2, 3, 4, 5, 6 transactions sitting in my cash account. So my total for the financing section, if I add these 3 numbers together, it would be 3,000 minus 50 is 2,950. Oh dear. And so my net change in cash is my change from operating, my change from investing, and my change from financing. So I would do 200 minus 1,500 plus 2,950. And so my change in cash is 1,650. I started this year with 0 cash, so my ending cash is 1,650. And that should match the balance sheet, and it does. Okay, so that's how you do a cash flow statement. Haven't done one in a while. So let's do another one. Okay, so this is the last page of our notes. So what we have is we have several transactions 1 through 8, and I'm not going to have you put them in like the T accounts and then income statement, statement of retained earnings, balance sheet, because we already practiced that. So what I'm going to do is I'm just going to go next to each of these transactions and I'm going to identify if they're operating, investing, or financing. So transaction 1 says during 2023, we provided services to customers for 2,000 on account. So the question is, did we receive any cash? And so this transaction was revenue because it's money from customers, but it's on account. That means we did not receive any money today. We did not receive any money today. So this is not cash flow. So this would be none. It's not going to go anywhere on our cash flow statement because you wouldn't deposit any money in the bank account from that transaction. This one says incurred various operating expenses totaling 1,200 on credit. So again, no cash changed hands. This would be operating expense and we're going to pay later, accounts payable. So no cash. But transaction 1 collected 1,500 from customers. That will be operating because this is money from customers. Customers go in the operating section. So I am not going to pick up the 2,000 at all. I'm only going to pick up 1,500 of it because that's what I received in cash. Number 4 says paid 1,000 on the accounts payable from number 2. So this is us paying our operating expenses. So this will also be operating. Number 5, we're going to buy a CD. We're going to invest in a CD with a 10% return on a 36-month term. So that means that we bought a CD at the bank. That's us investing in others. We're investing in the bank. Record interest earned on the CD. Okay, so that CD is not going to pay any interest until 36 months. But we all know that we would use I equals PRT, and we would calculate how much interest we earned. And we could do that. It's 500 at 10% for 1 whole year. We bought it on January 1, so it's 12 out of 12 months or 1 year, and that's $50. But I'm not going to receive any money today. So that $50 would be considered interest revenue and interest receivable. The R ones go together, receivable and revenue, but no cash was received today. So no cash flow. Paying a dividend to owners is financing. So you guys look, all I have is I have 1,500 here that's going to be operating. Okay, I have paid 1,000 here. So, and again, that will be operating. This one, I invested 500 and that's going to go in investing. But this one's no cash. Oh, I forgot to do the last transaction. Okay, so this paid 100. That one's going to go in cash flow. Accrued interest on the note payable. Now I have to go pause a second and take a look at this note payable. So if you go back to the previous given, we borrowed money, but we don't have to pay it back until March 31 of 24. So if I equals PRT, we borrowed 1,000 at 8% interest. So I went ahead and did it for you. So 1,000 at 8% interest, and this would be 12 out of 12. I might change that. But again, I'm not going to pay any of that interest today, so it's irrelevant. So only 4 numbers are going to go on cash flow. We are going to receive money. So these 2 are operating. I have 2 operating, 1 investing, and 1 financing. So the money received is only 1,500, and the amount paid is only 1,000. So we are going to receive 500. We're going to pay money to buy the CD minus 500, and we're also going to pay a $100 dividend. So it looks like the net change in cash is just these 3 numbers summed. The 500 and 500 cancel out, so we would have minus 100. Beginning cash was 1,650. That's from what we ended with last time. We ended with 1,650 1 year, so we'll begin with 1,650 next year. So my ending cash would be 1,550. And if we drew a cash T account and we would have done the transactions, that would have matched the balance sheet. So that is, thank you. That is it for this chapter. And so I hope this made sense. You only have 2 tabs of homework for chapter 12. It's just a solid review of doing some cash flow stuff. So I'll make a homework help video for it too. So hope you guys are doing well, and I will talk to you later. Thank you.